This was written in 2009. It came out in the print edition September 21st of the New Yorker. Now, I read this first time in my macroeconomics class back in college. And I've been wanting to read this again. Now, before I kind of took a break from this, I did read a little bit about this. It's very dense, man. And I might as well just do two things that I've always wanted to do, which is reread this and share this with you guys. So, 8 Days, the battle to save the American financial system. For those of you who don't know these people involved, Ben Bernanke, he was the chairman of the Federal Reserve. So, printing money, interest rates, etc. Tim. This was Hank Paulson. Hank Paulson used to be the CEO of Goldman Sachs, but at this point he was the Treasury Secretary. And then this is Timothy Geithner. He's the chairman of the New York Fed. The way that the Federal Reserve works in America, there's different regions. There's the St. Louis Fed, the New York Fed. Yeah, lots of different regions. In fact, maybe that should be our first thing we show you before we even talk about this more. So, the Federal Reserve, different regions. So let me search this up right now. Give you guys the different reserve banks. Let's see. There it is. Here we are. So by the way, guys, I just figured out how to do this. Check this out. I can actually appear with the video. So, you guys see me? See this? So, you see that? So the New York Fed right here, the New York Fed is very, very powerful. In fact, in the beginning of the Federal Reserve's history, the New York Fed was the most powerful. And then, see the St. Louis Fed right here, right? St. Louis Fed. What's interesting is it's called by its city, not by the state region. So I guess what city's sort of in charge of the area. So St. Louis Fed, very powerful region too, the New York Fed. I've lived in Philadelphia. I've never heard about the Philadelphia Fed. That's pretty funny. So now you guys know. This is the 12 districts in the Federal Reserve. So when I say that Timothy Geithner in 2009 and 2008 was the chairman of the New York Fed, he was part of here, right? There's the Boston Fed too. See, we never hear. The only Fed districts we hear about is the New York Fed and the St. Louis Fed. You never hear about Chicago, never hear about any of this stuff. St. Louis and New York, that's what we hear about. Anyways, so now you know how the different districts of the Federal Reserve. Now with that context, let's start reading. By the way, guys, I will take breaks to read your comments because I know just by how I title this, there's going to be a lot of people who are either into economics or have economics degrees who will want to comment, right? So I encourage all of you guys, especially those of you who have any kind of interest in this, to leave your comments as we read. But until then, we're just going to read. Originally, I was trying to put the article on the screen too, but it didn't work out that way. But I have it linked in the description if you guys want to read. So, anyways, here we go. The most important week in American financial history since the Great Depression began at 8 a.m. on a Friday in the middle of September last year. So in this case, last year means 2008. So again, this was written in 2009. So this was 2008. I have pieced together this account of it from scores of interviews with participants and observers. Many of the principals agreed to be interviewed, including Henry, aka Hank Paulson, who was the Treasury Secretary, the Secretary of the Treasury, Ben Bernanke, the Chairman of Federal Reserve, and Timothy Geithner, who was the President of the New York Federal Reserve. As time has passed, memories inevitably have been colored by hindsight and efforts to shade the truth. I love that this author is sort of putting his own kind of thing, what do you call it, his own analysis into it even before it begins. To affix blame and claim credit, but as one Treasury official told me, referring to himself and his colleagues, For better or for worse, we're the ones responsible. The more accurately the story is told, the better our policies will be received. As Bernanke hurried to the Department of the Treasury for his weekly breakfast with Secretary Paulson, crisis loomed. Lehman Brothers Holdings, a global financial services firm that started out as a dry goods store in 1850, faced imminent bankruptcy. For those of you who know, who remember or have read into, if you're too young, the financial crisis, you know that Lehman Brothers eventually completely failed, right? What's interesting about this is that Lehman Brothers has been around since 1850. So it'd be kind of interesting to see what Lehman Brothers looked like in the 1850s. I guess we'd have to look at the Library of Congress, maybe. I'm really curious what kind of stuff they would have for the Lehman Brothers. But yeah, I'm gonna go to Library of Congress. Let's see if we can find what Lehman Brothers looked like in the 1850s. They went from a dry goods store. To a big financial institution. Let's see if we can find. Let me just show you what I'm looking at. By the way, the Library of Congress, everything here, you guys can access. So, Lehman, Abraham, and Company. So I guess the Lehman Brothers. Who are the Lehman Brothers, right? Lehman, Abraham. They supported the Confederacy. Yeah, he was a cotton merchant. Interesting. I just want to see like a picture. Lehman Brothers. Oh, here we go. You see that? You can put a date range to this. Let's see if we can find anything. Lehman Brothers. I want a picture. By the way, I highly recommend searching the Library of Congress whenever you want historical information. Whatever. We tried. But basically, Lehman Brothers has been around for a while. I didn't know that until reading this. So, its collapse could be... So, right now, the author's sort of taking us back in time in 2008, right? We don't know if Lehman Brothers is going to collapse yet. Of course, we now know it collapsed. But imagine you're in September of 2008. Where was I? Oh, its collapse could be catastrophic and a solution had to be found that weekend before markets opened on Monday. Paulson, a former chairman of the powerful investment bank Goldman Sachs, I always laugh at that. All his friends are probably still in Goldman Sachs, right? If Lehman Brothers fails, probably that's good for Goldman Sachs. Again, that's not implying anything. It's just a little funny deduction for the sake of humor. Is tall, excitable, garrulous, and supremely self-confident. Reared as a Christian Scientist in the affluent Chicago suburb of Barrington Hills, he was an Eagle Scout in high school, a football player at Dartmouth before graduating from Harvard Business School. Again, Hank Paulson, the Treasury Secretary at the time. Paulson doesn't use email. Wow. People, can you imagine the days when you still didn't use email? This was 2009, 2008, right? Paulson doesn't use email and tends to ask rapid-fire questions in a distinctive, raspy voice. He once told a colleague, "I didn't get the charm gene." Nor evidently did Bernanke, a soft-spoken former professor of economics at Stanford and Princeton. When White House officials first interviewed Bernanke for the post of Fed chairman, he was so quiet they worried he had lacked, as one put it, assertiveness. He grew up in a small town in South Carolina, played alto saxophone in the marching band, and wrote an unpublished novel. Ooh, we should look this up. What unpublished novel did Ben Bernanke write? What do you guys think? What subject do you think he would have written about? Probably economics, right? Ben Bernanke, unpublished novel. Let's see what we can find here. What is his unpublished novel? Ooh, he published it. It looks like he published it. Oh no, this was this is another novel. So let me show you guys what I'm looking at. Ben Bernanke, after the financial crisis, wrote a book on it. You see this? Ben Bernanke wrote a book on this. So I guess maybe we should read this. This might be a good one for us to kind of read. But it's going to be biased, right? I'm sure people see the bias. Yeah. Let's see. Bernanke's thesis that the Fed's public messaging is a critical policy tool. Paulson and Timothy Geithner all wrote books on this. Of course they would all write books on this, right? I mean, you got your legacy to care about. Yeah, see? Hank Paulson wrote something. Geithner wrote something. Okay, all right. I think we have a bunch of books to read now. Okay, perfect. Anyways, you see, I'm telling you, if I finish this, it's going to be like 8 hours. We're going to spend a lot of time. So we might have to do a part 3 and a part 4 because I don't think I'm going to finish this today. But this is doing a deep dive, right? This is what I enjoy doing. Okay, so Bernanke grew up in a small... Oh, yeah, we did that already. Bernanke graduated from Harvard summa cum laude. I believe summa cum laude means you have at least a 3.7 GPA, and earned a PhD in economics at MIT. Ooh, MIT. He is an expert in the economic history of the Great Depression. So, this is Milton Friedman's book about the Great Depression. I was trying to find Ben Bernanke's publication on the Great Depression because I read it in macroeconomics class, but I couldn't find it. I don't know where I put it, but it could still be at home somewhere. I just haven't found it. But yeah, Ben Bernanke is very studied in the Great Depression. Now, is he an expert, right? Because the Great Depression is a very complicated period in American and world history. He might be an expert in a specific area, probably monetary policy, but I don't think anyone can be an expert in the Great Depression. That's just my bias right there. I don't know. ChatGPT might one day become an expert in the Great Depression, but no human, I think, can do it. Anyways, guys, both men, aka Paulson and Bernanke, were appointed by President George W. Bush. Guys, remember Bush? Our decider. But unlike the administration's free market absolutists, they, along with Geithner, considered themselves pragmatists, proponents of government action when markets fail. The two camps had long coexisted among Republicans, sometimes uneasily. But during the Bush administration, with its anti-regulation rhetoric and cuts in marginal tax rates, free market proponents seemed to be in their element. Bernanke's predecessor at the Fed, Alan Greenspan, kept interest rates exceptionally low. Yep. Regulators at the Securities and Exchange Commission tolerated high leverage at investment banks, and the Fed and the Federal Deposit Insurance Corporation tolerated lax real estate lending standards. Housing prices shot up. Yep. So the Austrian School of Economics really was not for the boom part of this, right? Basically lowering the interest rates below what market was and then causing the real estate bubble, right? But I think even in 2009 when this article was written, I don't think anyone debates that Greenspan, the Federal Reserve chairman before Bernanke, probably didn't do that good a job, right? Is this whole boom and bust cycle, right? They call it. I'm trying to phrase it correctly. This whole boom and bust cycle. Now, some people would say, when it busts, you got to recover. Some people be like, no, just don't start it in the first place. Now, how would an economy grow if you didn't have a boom and bust cycle, right? I guess I drew this graph the other day, and maybe we'll draw more graphs. So I call this consumption and time, right? And this is from the Austrian School of Economics too. So consumption, aka people buying stuff, people spending money, it's gonna go down sometimes. You know why? Because businesses are gonna do R&D. Businesses are gonna develop new products. But if you allow them to do the R&D, aka you allow more investment to happen in the economy, eventually the entire economy is gonna grow, right? If companies create new stuff, if we have new products. So I think you have to think long term. Of course, politicians sometimes they don't like this period, right? Because it looks like the economy's not growing, but the economy is growing. It's just it's preparing itself to grow, right? So maybe a way to think about this is that I don't want to call it a contraction. That's not a contraction, but like how do you know when the economy when companies are kind of investing in R&D, right? They're investing in other things beyond what's facing the consumer. There's another thing. Wow, we're really diving into the Austrian School of Economics here. This is something that I don't know if any of you have heard about, the production triangle. So I don't know if you guys have seen this before. This, I believe F.A. Hayek created this, but basically it's like the more in the beginning of developing a product or whatever, right? A lot of the costs are not loaded up to the consumer, if that makes sense. So this is consumption, right? So like if I have a product at Walmart, let's say I'm selling something like this, right? Then consumers are buying this. But in the beginning, to develop this product, I got to take out loans. I got to do stuff. So this is what it means. It's not a function of how much time or effort this takes. I just want to make sure. It's just it's how much the costs are passed down to the consumer. If any of you have seen this stuff, like this stuff is really, it's a really good way of describing how the unseen parts of the economy work, right? Because obviously so much is focused, especially in America, so much is focused on money and consumption, aka like purchasing, right? But there's way more to the economy. Anyways, this inevitably, right? I guess we can talk about this too, since we are talking about this. I'm sure anyone that's studied economics knows this formula, right? This is how you calculate GDP. Consumption plus government spending plus investment plus net exports. But obviously the government spending is taxes, right? Like the government spends whatever taxes get taken from consumption and investment. So technically, you see, you get the humor in that. It's like, but then of course, at least American governments, right? We don't have a balanced budget amendment, so the government can technically take on debt. So sometimes it's spending a lot more than just what it's taken in taxes, right? Or whatever surplus it has from previous years. Anyways, that's very complicated. If any of this goes over your head, people, I would highly recommend, all this stuff is available online now. I'm sure there's free macroeconomics courses. None of this stuff is rocket science. If you spend like 2 months studying this is going to really help you understand the news better. I'm trying to encourage one of my friends, Alex. He's into this stuff, but unfortunately he's reading the wrong literature. And I'm trying to at least get him to read some of this stuff. Just because a lot of you guys know, people like me who study politics, philosophy, economics, psychology, our BS meter for literature is different, right? Like if you've never studied this stuff formally, then you don't know what to trust, what books, what experts, right? But me, because I've studied this stuff, I know, okay, all right, this is what the math derives, this is whatever. And so my BS meter, whenever there's a book that, let's say, claims too much, or an author that claims too much. Anyways, back to the scene. We're gonna talk for 8 hours, man. Maybe since I went on a tangent, we should read comments. Let's see if anyone commented. Cheryl Butler says you like the BBC, so you like to read you like the BBC News Network? Oh, Caramel Dreams is here. Yes, Caramel Dreams. I agree with you. GDP is a government contrived measurement. I 100% agree with you. And we're gonna look at this one more time, right? Check this out. I drew this last time. Caramel Dreams was in the live stream, but obviously, consumption and investment shouldn't get added together, right? Because, I mean, in the aggregate, I guess it makes sense. But think about an individual. If I take all my money and I spend it, I don't have any money to save or invest, right? If I invest all my money and can't keep it all in the bank or put it in stocks or bonds, etc., I don't have any money to spend. So to the individual, C and I, so consumption and investment, it shouldn't just get aggregated. You see how, I guess from a macroeconomics measurement, you can add, but yeah, these two kind of like how I made the joke that G just takes from the C and I, right? But C takes from the I, just like the I takes from the C. So this measurement doesn't show that a lot of these are inverse relationships. So yes, Caramel Dreams mentioned something very important. So Caramel Dreams, reach out to me. I would love to interview you. I know you've studied economics. I would love to talk economics with you. So we haven't even gone through the first section yet. I love this. So where are we? Oh yeah, we're talking about Greenspan. In October 2007, the Dow Jones Industrial Average reached a peak of 14,093, unheeded by Bernanke, Paulson, or just about anyone in a position of authority. An asset bubble had grown to perilous and historic proportions. That year, the bubble had began to deflate. Yep, exactly. Most people don't realize. The Austrian School of Economics knew this, but in 2007, they knew that it had already burst, but the average consumer, the average person, didn't feel it until 2008. So that year, aka 2007, the bubble had begun to deflate. Defaults among subprime mortgage borrowers rose, and then the elaborate infrastructure of mortgage-backed security started to erode. In an attempt to contain the damage, Paulson and Bernanke presided over what many considered the greatest government intrusion into markets and finance since the 1930s. In March 2008, the government ushered the failing investment bank Bear Stearns into a merger with J.P. Morgan. Last article, we explored that. A deal that was made possible by $29 billion of government financing for Bear Stearns' troubled assets. Exactly. That was in, but that was finalized in December, by the way. Anyways, this matter. In early September, the Treasury rescued the government-backed private mortgage agencies Fannie Mac and Freddie. I said Fannie Mac, Freddie Mac and Fannie Mae. I mean, people just lump them together anyway. So I just called them Fannie Mac, but yeah, it's Fannie Mae, Freddie Mac, but people just call them Fannie Mac or Freddie Mae. Pledging up to $200 billion in capital. Dang, man. So we're just going to add all this up, okay? $29 billion and then $200 billion, right? And this is before even they bailed out AIG. So we'll get to AIG. I'm sure they will get to AIG. Public criticism of Paulson and Bernanke was scathing. The bailouts had brought into rare alignment the Republican right wing, averse to any tampering with the free market, and the Democratic left, outraged by the government rescue of Wall Street's overpaid elite. Yes, there's a concept, I don't know if it's political economy, economics, or sociology, one of these. It's called moral hazard, right? If you're just going to get bailed out, then you don't get punished for bad behavior. So moral hazard, you guys might have heard that. Senator Jim Bunning, Republican of Kentucky, called for the two men to resign and argued that the bailouts were a calamity for a free market system. He stated, simply put, it is socialism, and told a Bloomberg journalist that Paulson was acting like the Minister of Finance in China. Nouriel Roubini, an economics professor at New York University Stern Business School, who had warned about the housing bubble in 2004, declared that socialism is indeed alive and well in America, but with a twist. This is socialism with the rich, the well-connected, and Wall Street. So, Nouriel Roubini is he a neo-Keynesian or a new Keynesian? So, Nouriel Roubini. So, what's funny, they quote Roubini because Nouriel Roubini is not a free market advocate. Let's see. He is, what is he? I gotta look at what he studies. Noriel Roubini. Actually, first of all, let me share my screen with you guys. But second of all, how do I don't want to look on Wikipedia. I want to look on his actual page. But a lot of times Wikipedia is the best place to at least get started because you look at where they quote, right? So where did they quote? There it is. What is he? I know he's a Keynesian. Let's see. I know he's a Keynesian. So he does believe the government should come in and help the economy, right? He's definitely not a free market guy. Let's see. Noriel Roubini, economic view. Let's see. This is important because you quote someone like Roubini, you got to know where he stands on these things. Let's see. I'm pretty sure he's either a new Keynesian or people call him Dr. Doom. He's always predicting doom. He's either a neo-Keynesian or a new Keynesian. So for those of you who don't know what I'm talking about, and maybe one of you in the comments who studies know more about this, but Keynesian, right? The guy Keynes, John Maynard Keynes, most of modern macroeconomic theory comes from him. A lot of this, like C plus G plus I, this is basically it's I'm blanking on it's Keynes. It's Keynes. Anyways. Aggregate demand, all this stuff, that's Keynes. So the previous afternoon, September 11th, Timothy Geithner at the New York Fed had told Paulson and Bernanke that Lehman was unlikely to be able to open for business on Monday. Since its origins in cotton trading, Lehman had underwritten countless stock and bond offerings, had become a force in mergers and acquisitions, and was perhaps best known for its bond index, the equivalent of the Dow Jones Industrial Average for stocks. In 2005 and 2006, it was the largest underwriter of subprime mortgage-backed securities. There you go. It dug its own hole. As recently as 2007, Lehman had reported record profits, thanks largely to its leverage of 30 to 1. Okay. You wonder what 30 to 1 it's going to define, watch. Meaning that for every dollar of tangible capital, it had $30 of debt. Okay. Every dollar of tangible, okay, like it could pull out, it had $30 of debt, man. Lehman Brothers, man, doing a good job. My macroeconomics professor in college was one of those bankers at Lehman Brothers. I'm not going to say who she was, right? She liked me, so I had no problems with her. She really liked me, because obviously so many years later, I'm still thinking about this, right? She could tell I was very intellectually curious, but nobody else liked her. I feel so bad for her. You come from Lehman Brothers, and she obviously had a bias because, getting us to read Milton Friedman, right? But still, I think she was a really cool professor. Yeah. She never really talked about her time at Lehman Brothers, though. That's the thing. But let me read some more of your comments. Caramel Dreams says, Caramel Dreams liked my Chinese dating show stuff. Yeah, exactly. That stuff everyone, I think, found fun, but let's be honest, like, obviously you guys can tell I like this stuff better, right? This is better for my intellectual curiosity. Like the Chinese dating show stuff was fun at the time, but obviously I gotta move past. You guys don't have to move. I gotta move past beyond that. Like, I got so many things I love. You guys know. That's why I changed the channel. It just used to be my name. Now I put polymath behind it because that's basically what I am, right? I like to deep dive into many things. And very few people can maintain a life like that, but I've managed to maintain a life like this after so many years. So, anyways, most of Lehman Brothers' assets were funded by borrowed money, and now, given the steep decline in mortgage-backed securities, no one believed that the assets were worth their nominal value of $680 billion. Lehman's share price was down 94% from the previous year. Ugh. A run on its assets were already underway. Its liquidity was vanishing, and its stock price had fallen by 42% just the previous day. It couldn't survive the weekend. Global markets and the financial system were far more fragile than they had been in March when Bear Stearns faltered and Geithner, aka the New York Fed president, warning that the consequences of a Lehman bankruptcy would be quite bad, argued that an alternative had to be found. Otherwise, he said, the damage almost certainly would not be contained. Bernanke, coming from a different perspective, had arrived at much the same position. As a scholar of the Depression, he had argued that the collapse of banks and other financial institutions at the time had made the Depression much worse by constricting credit. Exactly. So Bernanke and Milton Friedman would argue that the banks, the stock market all collapsed in 1929, right? But why didn't the economy recover? Because you all know FDR came in and tried, right? We built roads, we built parks, we tried to put people to work, but the economy still wasn't recovering. So why was that, right? You can't spend and take out debt, which is what the government does, right? You can't spend and tax your way into prosperity. As much as we like the government to come and save us all, I mean, sometimes I don't want to work, but at the end of the day, the government just takes tax money, right? Or else if it's not taking our tax money, it's borrowing and it's doing stuff that you can't build an economy like that. So the economy has to recover. How does it recover? So Bernanke and Milton Friedman argued that the monetary policy was too tight, as in credit was too tight. So the economy was trying to recover. Businesses were trying to start. Let me go back to this triangle. You know, people were trying to start here, right? But you didn't give them loans. You didn't have the right interest rates. So Bernanke and Milton Friedman would argue that the reason the Great Depression was even a Great Depression, not just the stock market crash, because again, the stock market has crashed many times, right? But why was it so bad in the 30s? It's because monetary policy was too tight. Now, those of you who watch this, whether now or later, you guys have probably done more research into this. Obviously, there's a lot of facts and figures, etc., to support or not support what Bernanke and Milton Friedman would say, but it makes sense logically to me. Again, I don't study this stuff, but it makes sense logically to me. You know, everyone's scared, right? Everyone's scared after the economy goes bad. And that's why someone like Bernanke or Greenspan would argue that's where the Federal Reserve, a central bank, comes in to sort of give it a nudge, right? Give it a nudge. It's better, in their opinion, than the federal government, you know, directly trying to do stuff, which is what FDR did, right? He had become a proponent of intervening to provide liquidity and encourage lending. Exactly. So let the Federal Reserve, let the central bank do it. He argued that the risks of insufficient action, lack of action, had led Japan into a prolonged slump in the 1990s, were far greater than those of overdoing it. So obviously, I don't think Japan was completely a central bank issue, right? Part of Japan's problem was a foreign exchange rate issue, right? I don't think, again, I don't know if this is the author of this article or interpreting Bernanke or Bernanke saying this, but I don't think Bernanke would have said something like this. I don't think Japan's issue, when Japan crashed, a lot of it was not due to central banks. You know, there was an exchange rate problem in Japan, right? That's why Japan Japan got so rich. I mean, China was kind of doing the same when its economy was on the up and up, right? And then finally Trump tried to go after China, but under Biden, China's exchange rate went back to where it was. Like under Trump, I think at a certain point it was like $1 to maybe 6 RMB. RMB is like the Chinese version of we call it yuan in Chinese. But now with Biden, I believe, and we can confirm this, it's actually gone back to 8. So dollar to RMB exchange from, let's just do a little comparison, 2016 to now. Because I remember I looked it up the other day and I was like, what the heck? I was so surprised that it went up again. Yeah, let's see. So according to this, it's not what so, it was at its most historic around when China was first starting to get on the world stage economically, right? So $1 at the time almost got 9 RMB. And then eventually, I remember when it went down to 7 under Obama, right? And then it reached, so it went back up, and then Trump tried to fight a trade war with China. So Trump got it back down again. And then, so it went back down again, but it's been slowly climbing up again. Okay, so it's back at 7 again. I was so surprised because I did remember under Trump, it got down to 6. So even under Biden, it got down to 6 too. But so I misremembered under Obama, it went down to 6 too, but I didn't remember that. So that's interesting. So, yeah, because there was a few years I didn't go back to China to visit my family. So I didn't know that under Obama it went down too. But like that's a different reason for it going down, right? This was, I think, China's economy was just doing really well. Whereas like under Trump, Trump was really going after China. So there's different reasons why it went down, the foreign exchange rate. But I guess we could look at Japan. We can look at dollar to yen exchange rate. So we'll go 1970 to now. Right. We can look at this historical data. Oh my God. But you notice here, when the Japanese economy really started crashing, you see how it kind of like really went down? You see this, right? So the Japanese economy crashing, I really don't want to say is what this article is claiming, central bank restricting. It could have been a reason, but notice this, right? It was this. The foreign exchange rate really got messed up here. Now, you could argue it was messed up here. That's why Japan grew so much, right? That's why everything was produced in Japan for quite a few years. But anyways, let me finish this paragraph and then I'll read your comments. Paulson had headed Goldman's investment banking operations, including mergers and acquisitions. Man, Paulson, dude. As his chief executive, he had first opposed, then embraced the firm's decision in 1999 to go public, showing both flexibility and decisiveness. But as Paulson and Bernanke sat down on September 12th, the morning news included reports in which anonymous Treasury officials appeared to say that Paulson was ruling out the possibility of any government financial assistance to Lehman Brothers, that is, for those of you tuning in. By the way, for those of you tuning in, first of all, welcome. Second of all, this is our second part in exploring the financial crisis that still is messing up the world. Now, why am I doing it now? Because when I was taking classes on this stuff in college, I saved some stuff that I knew I would get a new perspective on as I got out of college and worked in the real world. And this is what I'm doing now. These were some mind-blowing it helped me so see the full picture readings from that time, right? I went to college around the time of the financial crisis. So now as an adult, I've done a lot of things. I've had to pay taxes. I've had to do a lot of stuff, right? You can kind of look at this from different. By the way, I'm also studying to be a tax preparer, and maybe it'll lead to me becoming an accountant just on the side. As you guys know, the word for me I learned last year, I'm a polymath. It just means I'm a guy that wants to get good at a lot of things. I have the ability and I have that grit, right? I want to learn. So 5 years down the line, if I still post videos, I probably will have an accounting degree and probably have a law degree. Just how my mind works, right? Some people say I'm on the spectrum. I probably am, but it's a blessing in disguise because it helps me able to devote my time to a lot of things that maybe other people at my age might be married or have kids, but my baby is this mind. Anyways, going back to here. So Paulson had acknowledged to Bernanke that he had authorized the comments. He was under intense political pressure from the White House and Capitol Hill to curb the furor. I also didn't answer. Oh yeah, I did answer. Never mind. I did answer the. Anyways, so the furor, F-U-R-O-R, furor. I've never been able to pronounce that word. Over the rescue of Fannie Mae and Freddie Mac. We joked Freddie Mae, right? Like nobody knows the difference between Fannie Mae and Freddie Mac. Should we look it up? Let's look it up. Might as well. Let's see what the difference between Fannie Mae and Freddie Mac. Fannie Mae. I've always, even before they were bailed out, I always thought they were the same thing. I mean, they both sound the same, right? So Fannie Mae, Freddie Mac. Let's see. I mean, both of them are involved in home ownership. I noticed that they're technically owned by the government, but they're still a .com. Hey, a little deceptive there. Aren't you owned by the government? Or are you just insured by the government? So, let's see. Let's see what we can find here. So again, rent, buying. Why buy and oh, I get it. You buy and then you own. Okay, I see. So like, what exactly are they? So, America relies on Freddie Mac to support the housing market, renters, homeowners, as a secondary mortgage market. So that's what Freddie Mac is. It's a secondary mortgage market. Okay, what about Fannie Mae? Affordable house. So Fannie Mae's affordable housing. What we do. Again, I still don't know the difference. I guess the difference is Freddie Mac's the market. Multifamily business segment. Oh, I don't know. You see why after all these years I still don't know the difference between these two? So that's why when I was first reading this, for those of you that have been here from the beginning, I accidentally said Freddie Mae or Fannie Mac or whatever. So where were we? Nevertheless, Paulson assured Bernanke he was committed to finding a buyer for Lehman Brothers. All summer, Paulson had been pressing Lehman's chairman and chief executive, Richard S. Fuld Jr., to find a buyer or a major investor for the firm. Fuld, at 62, was intensely aggressive. He joined Lehman Brothers in 1969, wow, as a trader and had subsequently driven Lehman's ambitious expansion. But Fuld had been slow to grasp the severity of the firm's plight, and Paulson was frustrated that Fuld kept insisting on what Paulson deemed unrealistic terms, including too high a price. Fuld's lawyer did not reply to requests for comment for this account. As a result, Paulson had taken upon himself to find a buyer, and he had come up with two serious candidates, Bank of America and Barclays, one of the largest banks in the UK. So Bernanke, too, had talked to Kenneth Lewis, the chairman and CEO of Bank of America. Lewis, a native of Walnut Grove, Mississippi, and a graduate of Georgia State. Any viewers from Georgia? Had joined a small regional bank, North Carolina National, in 1969 as a credit analyst, and had worked his way up the ranks as the bank transformed itself into Nations Bank Corporation by swallowing a succession of other banks and thrifts, and then in 1998 into Bank of America, whose headquarters were moved from San Francisco to Charlotte. Wow. We just got a history of Bank of America. I didn't know Bank of America started out as Nations Bank Corporation. Huh. He never fit in with his Wall Street or West Coast counterparts, and once remarked, "I've had all the fun I can stand in investment banking at the moment. Unlike commercial banks, which take deposits and make loans, investment banks raise capital for an array of financial services, from underwriting stocks and bond offerings to managing corporate takeovers to trading, acting both for clients and for themselves. Bank of America was a commercial bank, and Lehman was an investment bank, but Lewis was interested in it anyways, provided that the government was willing to lend against Lehman's bad assets." You know what's interesting? So you can see history happening, right? Because now when you think a lot of these companies that survived the financial crisis, they have traditional banking elements and investment banking elements. The fact that back in the day, investment banks and traditional banks were separated, I think it's just something that strikes me as odd now, because now you think of a lot of these big companies, these big financial institutions, they do all of it. They do investment banking, they do, some of them even do hedge funds, they do traditional banking, right? They do everything. They have their hands in a lot of jars. But back then it was more separated. Paulson had urged Lewis and Fold to talk. Again, Fold was the CEO, the president or whatever of the chairman of Lehman Brothers, right? And Lewis was the CEO of Bank of America. Meanwhile, Barclays president Bob Diamond, an American, saw Lehman as an opportunity to increase Barclays' U.S. investment banking operations. Paulson, in their first conversation, had been typically direct. "Bob, there's no government money." So obviously, again, for those of you who were here in the beginning, 30-1, man. Like, good stuff versus debt, 31-30, right? Nobody wants that. So people want the government to buy up the bad stuff, right? Obviously, if you're running a company, even a company as big as Bank of America or Barclays, you don't want that much bad stuff to come into your balance sheets, right? Obviously, I guess since we're drawing graphs, let me do this. You know about this, right? This is like, is this Finance 101 or Accounting 101? On one side is your assets, another side is your liabilities. You know this, right? The whatever it's called, the T sheet, assets and liabilities. Now the thing is, because of how complicated, and another flip of a coin, you could call it BS, right? But it's the same thing. How complicated, I'll just be objective, how complicated our financial system is. You could take things that technically are liabilities, and you can be like, no, I don't count them as liabilities, right? That's like Finance 101, right? A little cynical, but for those of you who study finance, you know it's true. There's all these things you cannot list on your T-sheets, basically. So we're almost done with this section, don't worry, and then I'll read your comments. I promise you guys. I know I saw you guys have a lot of comments, and that excites me because I love sharing knowledge and I love learning from you guys, man. I hope you guys have learned something from this too. I hear you, Diamond. Okay, Diamond is the president of Barclays. I hear you, Diamond replied, "We'll try." He took Paulson's comments as a sincere but not necessarily definitive. Barclays would see that it could offer for Lehman if there was a gap. Maybe the government was stepping after all. In the case of Bear Stearns, again, $29 billion, right? That the government bailed it out. The Fed had relied on emergency powers. He bestowed by the Federal Reserve Act that allowed it to lend in unusual and exigent circumstances. When the loans are secured to the satisfaction of the Fed, J.P. Morgan had guaranteed bearers' obligations until the deal closed. Over Bernanke and Paulson discussed a plan, first proposed by Paulson the day before, to engineer a similar private sector solution where Bank of America or Barclays would indeed receive financing for Lehman's troubled assets, but not from the government. Instead, other banks would be asked to join a consortium in order to spread the risk. In other words, Wall Street's strongest competitors would be asked to put their differences aside and act together for the common good. There was precedent for this in the rescue of long-term capital management in 1998 when William McDonnell, the president of the New York Fed, again, see, I keep telling you guys about the New York Fed. The New York Fed is very powerful, summoned bankers to address that crisis. Surely the bankers would recognize the failure of Lehman imperiled them all. Okay, now let's read what you guys are thinking right now. Oh, lots of comments. I love this. Lots of comments. I love this. Yep. Someone's going to mention ninja loans. I love it. Yep, exactly. Jonathan Schultz. Shout out Jonathan Schultz. Obviously looked into this. Yep. Ninja loans, right? No income, no job, no assets, right? That's what ninja loans means. That because of, and this is where Fannie and Freddie had a lot to do. But again, the incentive was created there. So I think we're going to have to do another graph, guys. We're going to have to create another graph. This is actually a really important graph. So where's my graph paper? Let's just do another one. Again, shout out that viewer. We're going to have to explain this. So this is also something that I think it'll make sense logically once I explain this, right? So think of this as the loanable funds market, right? And interest rates. So let me make sure I didn't accidentally draw the curves wrong. Let me just make sure. Maybe I'll do this later. I kind of want to get to the question, the comments first, so I'm like distracted. I don't want to accidentally draw this wrong. But anyways, so we'll get back to ninja loans. But yeah, ninja loans is definitely something we'll talk about. Ocean or Vital asked, do I work in it? I do not work in economics, but not opposed to it, man. I realized the past few years, I wasn't using my brain enough. So starting last year, I really started using my brain again. And so I'm back, man. I'm back. Of course, YouTube, you can't be as funny anymore. So maybe a less funny version of what I was, but definitely a way more intellectual version. One guy from Swiss Bank got jailed. No one. Oh, wow. I didn't know that. Schultz, who got jailed from Swiss Bank? Yeah, we're definitely in another bubble, man. I mean, our tech bubble burst already, right? We're in an AI bubble, but maybe you're talking about another bubble. You tell me, what is your bubble? Shout out viewer Ajit. Shout out viewer Cornish stocks. Caramel Dreams, the yuan is, yeah, exactly. It's pegged, exactly. So basically, what pegged means is that it's always going to be somewhere related to another currency. And in the Chinese yuan RMB's case, it's pegged against the US dollar. So basically what this means is when I showed that graph of how it sort of sometimes would go down, sometimes go up, that's more an indication of what's going on in America, right? So no, Caramel Dreams mentioned something really important, right? It is true that the RMB is pegged. It's not free floating. It's manipulated, basically. That's the whole point of why Trump was going after them. Right? Trump's like, you're basing it on how the American dollar is, so that way you can get beneficial trade exchanges. U.S. is a legal colony of Church of England. Okay, all right. Yeah, Schultz is talking about birth rates. Yep. I mean, in general, birth rates in the entire world is not doing well. Caramel Dreams is saying Freddie Mac is a government-sponsored enterprise. Yeah, that supports U.S. house buying. Exactly. Real estate investment trust. Yeah, gold is at an old-time high. Matt McCormick is here. Cool. All right. Let me get back to my graph. Let me just give me 1 second, guys, while I make sure. I really want to kind of explain this because I talked a little bit about this, but and maybe this is where we end this tonight because we still have a lot to go. And my roommate was filming for 2 days, so I want him to sleep. I hope I'm not causing him to not sleep. We still have so much, but probably we do need to explain this for everyone, because the one thing that the Austrian School of Economics gets so right is how you mess up the market when you start pumping, when you lower the interest rates or do other equivalent things to pump more loanable funds into the market than what should be, right? Like that's the thing that the Austrians get so right. And, you know, a criticism of that is, oh, you guys don't use enough math, man. But, like, who gives an F if it makes sense logically? You know what I mean? Yeah, anyways. So let me just make sure that I'm doing this straight. Yeah, that makes sense. Like people taking out loans. Okay, yeah. All right, here we go. I just wanted to make sure I captioned this correctly. So again, let's hopefully you guys can see this. Okay. As the interest rates go up, people want to save more, right? Why? What is interest? Interest is you take your money out after a certain time and your money's going to be worth more, right? Now, interest could be paid to you in different ways, right? Sometimes it could be paid to you every year, every quarter, every month, right? It depends. And for those of you that have interest income, you know you got to pay taxes on this, right? Sometimes you can not pay taxes on all that interest until you take it out, or sometimes depending on how you save, right? A Roth IRA, for example, you pay the interest now, right? You pay the taxes now, and then when you take it out, you don't pay taxes, right? So there's all these structures for how you get that interest. But the key is a bank encourage you to put money in their institution by saying, well, if you take it out later, give us time to lend this out, we'll give you more, right? We'll give you more, just give us time. So obviously when interest rates go up, people want to save more. Now, if interest rates are too high, right, people don't want to take out as many loans, right? The people who need the money that you need to lend to, if the interest rates are too high, then they don't want to take out loans, right? So there's a sweet spot depending on where the economy is, where the market is, where people's expectations are, right? This little equilibrium spot here. In a perfect world, right? Obviously, we don't live in a perfect world. One, because humans aren't completely rational. Two, there's always something called information asymmetry, which means we just don't always know everything, right? So even if we could be rational, sometimes we just don't know everything. And three, and this is where people who are free market would say, we don't have the right pricing mechanism here. We don't have the right equilibrium because there's people, aka Federal Reserve, other people, aka like tax law, right, that are changing up the price structure because of their messing with the signals. Do I need to? Oh yeah, I do need to explain this more, because think about Greenspan, right? Or you don't even have to think about Alan Greenspan. Think about when the central bank does things, and then we can do another in-depth video in the future on how it lowers interest rates. There's a lot of ways. But let's say it lowers interest rates, right? So I will have to kind of draw this out for you. This is when I wish I had different colored pens. But, so I'm going to draw this for you. It's so funny. I wasn't completely prepared. I'm just being honest. I wasn't completely prepared to explain this to you guys, but you know, sometimes we roll with it, right? So, okay. I should have drawn this bigger. I'm so sorry, guys, if this isn't clear, but I wasn't completely prepared to do this. So let's say the government says, oh, we need more people taking out loans. We need more people buying houses. So it lowers the interest rate, right? It lowers the interest rate. So suddenly the interest rate isn't up here where the market naturally equilibrates. Equilibrates, yeah. It goes lower. So you mess up the incentive structure. Now suddenly there's a lot more people taking out loans than should. And then there's a lot less people also saving, right? There's a lot less people saving. It's not just more people taking out loans. It's fewer people saving because, again, the interest rates are lower. See this? This is where it all starts. Some people who should have been saving are not saving, and people who shouldn't be taking out loans are taking out loans. Like, it's so beautiful how a little graph like this from the Austrian school can explain so much. Let me see if I want to explain this. Yeah, I'll explain this too. Give me 1 second, guys. I'm trying to draw. I love it. I love this, guys. I love you guys. So what we just saw can be reflected in this triangle, right? This triangle is basically the process from anything, anything. Putting an apple in the store, developing an iPad, right? There's a lot of stuff that we don't see. And then eventually, when the costs get put to the consumer, this the stuff we do see, right? It's a whole process. And Hayek represented it by a triangle. Now, when suddenly you mess with the market, you lower the interest rates especially, and now fewer people are investing than they should, but then also more people are taking out loans, right? You mess with this production triangle. So then there's a lot more consumption, but then there's also a lot more investment. All this is you could say it's built on a house of cards. One of you said that. One of you said that in the comments. So anyways, I'm just trying to give you guys different ways of picturing this. Sometimes you give people different ways of picturing this. It helps them kind of see it, right? I think this is probably the clearest way, but sometimes people don't like curves like this. That's why I was like, maybe using a triangle, using geometry. Let's see if I want to use this. Yeah, this is, remember earlier I showed you guys this too, like as the economy goes like this in a perfect scenario, because sometimes people will dial it back, they'll improve their product, they'll take resources, invest in new things, right? So in the long term, the ability of everyone to do stuff, purchase stuff, whatever, get more stuff is going up. But sometimes there'll be slight periods, right? Depending on how many companies, how many people will spend the time to R&D and improve their existing stuff before it gets loaded to the consumer, right? So every period here where it goes up, this curve that I showed you guys in the beginning goes outwards, right? How much you can consume, how much you can invest, aka save, right? Every time this goes up, after a period of R&D, etc., this curve goes out, right? That's how you expand. You make everyone better. In ideal economy, in the long term, this curve's always going out, right? You want to think about this. Let's say you have $800, right? If you have $1,000, then whatever you decide to do with it, this whole curve goes out, right? So if the government's artificially manipulating this, making you think that your ability's out here, but it's not actually out here, right? It's not real. So what I showed earlier of some people who shouldn't be taking out loans or taking out loans, and some people who should be putting stuff into banks are not, right? You can see it here too. I drew a little point out here, and then there's a corresponding spot here and a corresponding spot here. Those are the people who, let's say, before shouldn't have been investing or shouldn't have been consuming and are. Again, it doesn't matter if like you don't get 100% of this. Like, do economists even understand 100% of this? I don't know. What do you guys think? Should we read more? Should we call it a night, or should we look more into those charts that I love? Let's see what people are saying. Kareem Sarah Gelding is the only banker arrested during the 2008 financial crisis. By the way, Johann Schultz, are you one of my economist viewers? Let me know. I'm gonna look up who you're talking about right now. Wow. Okay. Let me show you guys. Oh, I got an article from the New York Times, and immediately. But the Justice Department has an indictment that we can read together. So let's look at this. Oh, he falsified the book. So yeah, commit wire fraud. I see. Wow. Whoa. Dude, shout out viewer Johan for letting us know about this. Whoa. He was at Credit Suisse as a managing director. He was the global head of structured credit. Abney. So he managed a book called Abney. Oh, subprime. Okay. Cash securities, AAA rated, non-AAA rated cash bonds. Whoa. So there's some more people. There's a guy named David Higgs. There's Salman Siddiqui. And then this is cool. I won't read this all today. Shall we read this? I don't know. It's kind of interesting, right? This is a little bit more technical than what we're doing right now with our articles, so maybe I'm not going to read this with you guys, but I appreciate viewer Johan for telling me this. I didn't know they actually charged a guy. Wow. Let's see. Caramel Dream says, find out the actual time and day when the central bank was created or usurped the U.S. government. Yeah. Um, Angelo Miz Angelo Mizilo? Wow, Johan's given me all these names I never knew. Who's Angelo Mizilo? Uh oh. Oh, Countrywide Financial. Okay, okay, yeah. It looks like we have maybe this is gonna be a 10-part series. I love this, guys. I freaking love this. Wow. Um let's see. What else? What else can we do? You guys keep talking in the. You guys keep talking in the live chats. Really love. I really love hearing everything that you guys are telling me. I'm just trying to figure out. Is there anything else I want to? Because again, at the end of the day, right? You could blame Alan Greenspan, you can blame whomever, but obviously there were perverse incentives, which is that the interest rates were not market standard, right? They were lower than market standard. So we have to understand what that does, to behavior, right? That's ultimately what macroeconomics is about, right? So I'm trying to figure out if there's any graphs, since I'm like drawing graphs all the time. If there's any graphs I need to draw that could shed light, but I think the ones I showed you guys, that's enough, man. Right? I don't know. Yeah. I'm just looking at my notes up here to see if there's anything. Yeah, doesn't matter. Let's see. It's 10:46 where I am. Do we read one more section? I think we'll stop it here. We will because we left on a cliffhanger. Would the bankers right now, the U.S. government is talking to Barclays and talking to Bank of America. Man, would one of the two try to buy up Lehman Brothers? Right. So maybe that's next time. Maybe tomorrow night we will look at how it all falls apart. Right. So if you guys haven't seen my first one, reading another New Yorker article, very well written too, but that was during the crisis in 2008. So that one was good too, and I never finished that. But I think there was a reason why I decided not to read all of that, because this one is much more in depth, and hindsight is 2020, right? It has a lot more information that article just didn't have. So I think we have a good stopping point. If you guys want to talk about anything related to this period or economics, we can have 5 more minutes devoted to this. Shout out viewer Wesley. Yes, I did study this stuff in college, and I still occasionally enjoy studying it, right? Johan says if I want to look at Countrywide, I'm gonna have to put on a hazmat suit. Wow. Yeah. Yeah. Exactly. All right, guys. Johan's getting too deep for me. It's making me want to go to sleep. But yeah. Also, as you guys know, I'm. If you guys want to learn more about all the stuff I'm looking at, I'm studying. Feel free to ask. Maybe I can show you some other stuff I'm studying. I do want to show you guys one last thing, which is kind of funny. So let me. For those of you who don't know U.S. tax law, I'll show you guys one thing. Most places in this world, right, want you to get married, right? Because theoretically, married families are much more stable. But let me show you this one thing that's just, this is so fascinating. Hope you guys can see this. So most people who do their taxes, or if I were to help someone prepare taxes, right? You use worksheets like this for people who make more than 100,000. And so check out the tax rate, how it differs for someone that's single versus a married couple, right? See, same, your threshold, America's tax is marginal. So once you get past the threshold, you pay a little more, right? On the amount that's past that. So that's called a progressive tax. So this is single right here. Married is section B. So the threshold to go into the next tax bracket is a little more for a married couple. And the tax rate, if you look at BB versus AB, for a married couple is also lower. And on top of that, the subtraction amount is also higher. You see that? Now, what about married? Married filing separately is, there's certain cases, maybe like the husband and the wife have businesses or they're about to get divorced and stuff. So married filing separately is different. And there's head of household. So there's different things, but definitely the married couple gets the best benefits, like the lowest tax rates. I found this really interesting. So for my homework in my studies, I was like filling out like a sample tax return for a married couple, right? And then I was filling it out, and then of course, because I'm new to this, I accidentally used the singles bracket, and I was like, this doesn't make sense. It's too high. And then I was like, I used the wrong section. And then in this section, I'm like, wow, you get punished for being single, man. I mean, that's subjective, right? Some people would see the headache of being married and then the headache of the state potentially getting into your marriage. If you ever want to dissolve it, that's not worth it, right? But financially, you're definitely punished for being single. So I just want to show you guys that was kind of funny. It's just, as I'm learning this stuff, I can show you some of the stuff that I'm learning. So I hope you guys like that one. Yeah, I think it's time to potentially end it, man. I'm getting a little tired. Thank you guys so much, man. This was really fun. Tomorrow, maybe same time, we'll explore some more.